Investment banks provide businesses and other entities with access to financial markets. If you are a business that wants a loan, you can go to a commercial bank. If you are a business that wants to sell stocks and bonds, you go to an investment bank. If you are a high net worth individual that wants to execute a trade, then you might also call your investment banker. This is an oversimplification, but it's not too far from the truth. In this session, we want to understand the who, what, when, where, how, why of investment banking. Our goal is to first define what an investment bank is, and then understand what these financial institutions do and how they're organized. Investment banks connect borrowers and savers directly in financial markets. Investment banks have three main business lines. The first is financing. Investment banks originate, underwrite, and place securities in financial markets on behalf of their customers. These customers are primarily large corporations and governments. Second, since investment banks are already in the business of creating and selling securities, most are involved in securities trading. They execute buy and sell orders for their customers and often trade to make profits for themselves. Investment banks also help to facilitate mergers and acquisitions or other corporate restructuring activities. All of these activities generate fees, underwriting fees, commissions for executing trades, and fees for giving advice. This can be a very profitable business, and unlike commercial banking, it does not require long-term funding or extensive branch networks. Let's take a look at the investment banking corporate structure, starting with JP Morgan Chase. Okay, here we have JP Morgan's business segments. We can see the corporate and investment bank over here. It sits within the wholesale business arm of the bank. This means that we are dealing with big clients and not retail customers like you or me. The investment bank consists of two businesses, banking and markets. According to their annual report, banking means advising on corporate strategy and structure, as well as capital raising in equity, debt markets, and syndicated loan markets. The markets business covers trading in cash and derivative instruments, as well as brokerage services. M&A advisory, securities underwriting, and securities trading. That's the business. And here are the fees. For JP Morgan, who is the global market leader, in 2020, they captured about $8.5 billion of investment banking fees. That is a sizable chunk of their annual revenue. There are many specialized firms in the investment banking industry. Some focus just on brokerage services. Other boutique investment banks focus on capital raising for a particular industry. However, we can classify the largest full-service investment banks into three buckets. First, we have the JP Morgans of the world. The investment banking arm of JP Morgan is a subsidiary of a commercial bank holding company. These are the largest investment banks, and they have a customer base that includes corporations, governments, financial institutions, and high net worth individuals. Second, we have investment banks that tend to have a more specialized customer base. Goldman Sachs's investment banking business tends to focus more on corporations and customers that are more active in securities trading. Finally, we have the standalone investment banks like Lazard. These firms offer a full range of investment banking services, but have a limited geographic footprint. They tend to just operate in major cities, and they tend to focus on larger clients. I just said the term standalone without really explaining what it means. Well, this is an industry that has gone through some major changes. In the past, we had several prominent independent investment banks. JP Morgan, Merrill Lynch, Bear Stearns, Lehman Brothers, Morgan Stanley. Today, the largest firms have merged with commercial banks and now sit within the holding company structure. This is what I mean by standalone versus affiliated with a commercial bank. Two merger waves brought us to this industry structure. First, regulatory changes in the late 1990s permitted commercial and investment banking activities to happen at the same firm. This caused several commercial banks to acquire or set up their own investment banks. And second, the financial crisis. This caused a wave of distressed acquisitions. By the end of 2008, Lehman Brothers was bankrupt. Bear Stearns and Merrill Lynch were acquired by commercial banks, and Goldman Sachs and Morgan Stanley had to reorganize as commercial banks in order to survive. Here is a list of the 10 biggest combinations in the US investment banking industry. Citigroup was formed by the merger of Citicorp, a commercial bank, and Travelers, which was an insurance company that owned an investment bank. This merger happened in 1998, at the same time as the passage of the Gramm-Leach-Bliley Act. Chase acquired JP Morgan soon after. Here is Bank of America acquiring Merrill Lynch in 2008. This was the largest distressed acquisition during that financial crisis. Here is a breakdown of investment banking revenue in 2020. We can see the top 10 investment banks globally. Only Jefferies is a standalone firm. The rest are affiliated with commercial banks and take deposits from retail customers. These 10 banks collect about 50% of the fees globally, and the market leader collects around 10%. So while there has been a lot of consolidation, this is still a fairly competitive market, at least on a global scale.